Hi, this is Poet Sam with this live webinar. It's a quick question, it's a quick idea for you, and we're going to explore it in more detail in next week's live webinar. But how can a trust protect a family or business? The issues around what you own and what your business is vary quite a lot. You as an individual have the absolute control of your assets until the day you die. But then any fixed or movable, any financial, any investments, any property need to be administered, and they have to be administered through an estate. And that estate is a form of trust. That trust has to have appointed trustees, which can generally be your family, or they can be a professional administrator to support the transition of your assets from one person to the next. The trust has its own tax entity, which on death is usually inheritance tax, which in the UK is at 40%, but in Cyprus is zero. So the trust transitions the assets from one party to another. Now, using a lifetime trust can sometimes be stigmatized without good reason. The way that we use a family trust is to protect the family's asset and business across board and down generations. Now, there is a tax implication quite often because that's an easy way for governments to control what they're doing. But as an administration process, if the tax and the trust administration is viable, it's a great way of controlling assets and protecting family against cross-border taxes and against the cost and delay of probate. When you've got a company, the shareholders are protected. They don't manage the company, the directors do. Now, the directors can be the shareholders, and if the shareholders die, the company can still operate under the executive authority of the directors. Although at some point, the shareholding will have to be disposed of. It's the same with the trust. You don't own the assets of a trust. What you do is you pass them over to a separate tax entity, the trust, which then owns those assets. So when you die, there's no inheritance tax assessment, which could be very good for some expats who want to claim that they're no longer domiciled to the UK and liable to 40% inheritance tax. So it's a really, really key point for expats to consider. So the trust may be subject to tax. So there's default taxes that apply in the UK and Australia, but in places like Cyprus, there's no tax on worldwide gains and assets, only on local Cyprus income and gains. But trusts are very much part of English law. So in many jurisdictions, trusts are not recognised as separate legal entities. So they have to be set up in the right jurisdiction, somewhere like Cyprus or the UK. But then they can protect those assets. In the UK, they're increasingly used for people that are elderly going into homes or care needs. The trust protects those assets to pay for those care needs. Cross-border, if the shares of the company are owned by the trust, or if the property is owned by the trust, or if the investments are owned by the trust, then there's no probate and potentially no inheritance tax on death. So that makes administration a lot simpler. You avoid the cost of delay and probate. But more importantly, the family living in different jurisdictions around the world are not constrained by different legal systems and different legal expenses. So that's the essence of how a trust can benefit family and business. For more information, contact us at proactpartnership.com. Get general advice by subscribing as a retained client at proactpartnership.co.uk, and subscribe to our YouTube channel, and comment and share it with your expat friends, so that we can all share the information and help and build and grow and protect family and business living and working abroad. Thanks for listening. See you next time.